Hi, I'm Aradhna Agarwal. I am a CPA.
Hi, and I'm Tina Gandhi, and I'm one of you. I get my tax tips from social media.
Today we are talking about something that sounds fake at first, but is very real in the tax code, Tina. Some founders sell companies and legally pay zero federal capital gains tax.
Okay, TikTok told me this exact thing, but it also told me I could manifest a startup and avoid the IRS. So before I emotionally commit, I need to know, is this for real or is this one of those ends with an audit situations?
It is real, Tina, but only sometimes. This strategy is called QSBS, which stands for Qualified Small Business Stock. It is not a loophole, it is not accidental, it's
Mhm.
very intentional rule in the tax code.
Okay, so the IRS intentionally wrote a rule that helps startups. This feels suspicious, but I'm listening. Please explain before TikTok finishes the story incorrectly.
QSBS is designed to reward people who invest early in qualifying small businesses. If certain rules are met, you may be able to exclude a large portion of the gain when you sell your company stock. And exclude is important. This is not deferral, it means not taxed at the federal level.
So when you say exclude, you mean the IRS just doesn't tax it? Because that word feels emotionally significant, and I want to make sure I'm hearing that correctly.
Yes, QSBS generally applies to founders and early employees who receive stocks in a qualified C corporation. And yes, the structure matters. Company must be a C corp, be under certain size limits when the stock is issued, operate in qualifying industries. This is not automatic.
Okay, so TikTok absolutely skipped the C corporation part. They made it sound like any LLC with a pitch deck qualifies. So you're saying structure and paperwork actually matter.
Yes, and here is the biggest mistake I see. People learn about QSBS after there is already a buyer. At that point, it's usually too late. QSBS requires proper structure from the beginning, correct timing, holding the stock long enough. This is planning, not a rescue strategy, Tina.
Okay, so this isn't something you casually Google the week before selling. And TikTok definitely made it sound automatic, which explains why this often goes wrong.
When QSBS works, the impact can be massive. It can exclude millions of dollars from federal capital gains tax. That's why founders who understand this rule think very differently about entity choice and equity from day one.
Okay, now I understand why people care. Millions is a very motivating word, but also terrifying if you mess this up.
Yes, and QSBS is not a hack or automatic or something TikTok can confirm in 30 seconds. Doing this almost right can still mean paying full taxes.
Okay, so TikTok probably shouldn't be a legal department, and confidence is not a substitute for documentation.
Yes, QSBS is a perfect example of how the tax code really works. It rewards early planning, correct structure, and long term thinking. Taxes don't punish success, they punish lack of preparation, lack of planning.
So it's not magic, it's not luck, it's structure, timing, and doing things early, which unfortunately the opposite of TikTok advice.
Yes, and follow the tax education that's legal, strategic, and intentional.
and explained in more than 30 seconds.
Thank you for watching. Don't forget to like and subscribe.